let's go ahead and get started. Appreciate everybody joining us today. My name is Jason Munson with Krog Street Partners, and we're going to spend some time together today talking about due diligence for multifamily real estate investments. I know that there are a lot of folks that have expressed interest in investing in real estate and really want to know where to start and how to begin their education process. So I wanted to spend maybe half hour, 35 minutes to get together today to go through how we look at real estate investments, different elements we think is important for you to take into consideration when you're looking at real estate investments and sponsors, and also leave some time at the end to ask some questions. So our agenda today, I'll tell you a little bit about us and Krog Street Partners and what we do, and then we'll get into really the basics of evaluating real estate investments. And I think this should be a valuable 30 minutes for you. So first of all, a little bit about Krog Street Partners. We're an Atlanta-based multifamily real estate investment company. We typically target value-add real estate, value-add multifamily. Now, we invest across the spectrum, the quality spectrum. So we'll look at Class A, B, and C multifamily. One thing that we focus on are deals that do have a true value-add component. That we can, through either some sort of capital expenditure, some sort of repositioning, some sort of amenity upgrade, that we can unlock value that the prior ownership was not able to take advantage of. So we focus in the Southeast. Typically, our mandate is roughly a 4 to 5 hour car drive around Atlanta. So that captures all the major Southeast MSAs: Atlanta, Nashville, Charlotte, Birmingham. We look at all the secondary and some of the tertiary markets as well. So really, the state of Georgia and contiguous states are the areas that we focus on. My partner Mohi and I are very experienced real estate professionals. We've got a combined close to 50 years of experience in commercial real estate across development, acquisitions, asset management, lending. So we've done quite a bit. And here's a summary that what we have done collectively as general partners and sponsors over our career: 18 deals, $326 million in capitalization. That's 1,823 units of development or acquisition, and we have averaged close to a 20% average annual IRR across those deals during our tenure. So we've done a lot, we've seen a lot, and continue to strive to do more. So the mission of Krog Street Partners, when Mohi and I got together to start Krog Street Partners, one thing that we agreed on is that we wanted to pursue and execute prudent business plans. We're not swinging for the fences on every deal, although those deals occasionally do come up. But we're looking for steady Eddie, stable, consistent investment returns with deals that make sense, that underwrite to a reasonable business plan, and also provide some level of cash flow during the whole period. And our focus is the Southeast United States, the Sun Belt and the markets that I mentioned just a second ago. This is a picture of my mug. Goes through my experience. I've got a pretty deep development experience. Also been in the institutional real estate side with a couple of private equity groups and a large brokerage. So I've done a lot over my years. And then my partner Mohi has a lot of experience in the acquisitions and capital market side. He worked overseas with a couple of sovereign wealth funds, doing large investments in the United States and Europe, and has also been involved in private equity. So between the two of us, we have a lot of experience in development, acquisitions, and managing real estate investments across many asset classes, with a particular focus on multifamily. So today, the primary reason that we're talking today is to provide a framework for learning about real estate investment, and specifically multifamily real estate. So a lot of what we're talking about will be complementary to any asset class that you consider investing in, whether it's multifamily, hospitality, self-storage, whatever it happens to be. These are a lot of the fundamentals that you want to consider when you're looking at a real estate deal. And I've say this often: real estate's not complicated. It's a business that you can transition from easily transition from other careers into real estate. Whether you're a finance professional, banker, lawyer, doctor, or whatever, there are certainly opportunities for real estate. It's not complicated, but it is very, very complex. There are a lot of moving parts that go into successfully executing a real estate investment, and we'll get into some of those elements further in the presentation. So, your business experience can be complementary and accretive to the real estate industry. But real estate itself also has a lot of unique issues, a lot of unique vocabulary, words, issues, so on and so forth, that I think it's very important for you to recognize and learn about. So I think this point goes to anything that you try new, and that's anytime you venture into something new, you need to commit some period of time to learning the basics, and that's whether you're learning about investment like this, or whether you're taking on a new hobby, whether it's tennis or jujitsu or poker or whatever you are interested in. There's a certain learning curve that's going to be associated to any new venture, and you need to be willing to commit some time and effort and money, frankly, to learn that business. And by money, I don't necessarily mean taking classes or anything like that, but buying books, attending webinars like this, subscribing to industry newsletters, so on and so forth. As I mentioned earlier, much of what we're talking about is going to be applicable to other asset classes in real estate beyond multifamily. But there are countless sources of free information out there. YouTube is your friend. Google is your friend. Other sponsors, websites, industry news sources, industry websites, daily emails, books, podcasts. There are countless sources of free information out there that will help you grow your knowledge base and make you better equipped to evaluate real estate opportunities. So there are no secrets in real estate. It's an awful lot of hard work. So if you hear those gurus that used to advertise on TV and may now have websites and emails promising to teach you the secrets of real estate, I'll dispel that right now. It's just a lot of hard work, and successful real estate investing is seldom a solo venture. It's you can't go it alone. It would be virtually impossible for one person to do everything, execute everything necessary to complete a real estate project, whether it's a development or an acquisition. There's a lot of moving parts, and we'll get into that in just a second as well. So real estate investing is a lot like any other investing. So it follows cycles. So this chart on your screen right now is a high level summary of the 4 phases of the real estate cycle. So depending on who you ask, we're somewhere between phase 3 and phase 4 of the real estate cycle at this point. We have been in a very healthy phase 2 for a prolonged period of time. We've been in an unprecedented bull run in economic expansion and real estate expansion. So that said, even as we go into phase 4, there are opportunities. So you just have to be more careful about how you identify and execute on those opportunities. We talk a lot about interest rates in the real estate business, and you probably hear those headlines or read those headlines in the news. Just as a point of reference, I looked this up last night. The Fed funds rate, which is the overnight rate that banks lend to each other, it's the key interest rate that you hear the Federal Reserve talking about all the time. In March of last year, March of 22, it was 0.08%. So Fed funds rate of 0.08%. 18 months later, as of earlier this week, it was 5.33%. So that's 525 basis point increase in 18 months. So so basically the cost of borrowing has increased by 5.25% roughly when that's extrapolated over the different forms of real estate debt that are out there. So clearly that's impacted the economy, or the real estate economy anyway, and we'll talk about the implications of those rising interest rates in this presentation as well. So how we're gonna cover this today is we're gonna cover 5 main questions, or 5 main elements that it would be helpful for you to define. I don't know if you took an English class in high school where the assignment was to write a news story, or a story like a newspaper I used to write. I don't know if you remember those 5 elements. It was who, what, why, where, and how. Who did it, what they did, why they did it, where they did it, and how they did it. So we're going to take those 5 questions, but we're going to put a spin on it for how we define our real estate thesis and how we approach a deal. We're going to look at why, where, how, why, where, who, what, and how. So we're going to answer these, hopefully answer these basic questions for you, which will also help you better evaluate real estate opportunities. So the first one we're going to cover is the why, and that's really for you to answer. That's defining your real estate investment goals. Why are you interested in investing in real estate to begin with? And I guess we all want to make money. We all want to generate income from our investments, but the wealth and income streams available from real estate don't all have the same level of return or timing. And so I think it's important for you to understand that it's not at all one size fits all opportunity, and one deal doesn't necessarily perform like another deal. So every situation is unique. So the question is, why are you investing in real estate? Are you looking for regular dividend income, a quarterly distribution or annual distribution of income? You're looking for capital growth. I invest 1,000 and hope to get 2,000 back over some period of time. You're looking to diversify from other investments, whether it's equities or bonds or other types of investments. And also at the bottom of the page, what is your risk tolerance? Because every investment has a certain level of inherent risk, and real estate is no different. So as we discuss what our expectations are, we also want to discuss what our economic return and timing expectations are. Real estate is typically a slow business. You're not going to invest in it and have a return next week, next month, or maybe even next year. So our belief is that you need to have a minimum return expectation of 3 years, or a minimum investment duration expectation of roughly 3 years, likely more. If you look at a lot of the offering statements for syndicated real estate deals, typically there's I think a 7-year window or lifespan of the investment. So anyway, so these real estate investments can take a little longer than a lot of other investment options. So in understanding that, it opens up the next question: do you need your investment capital back at a certain point in the near future? Are you planning on retiring at a specific date? You have a purchase that you're making on at a specific time, whether a house or a trip or whatever. So you need to take that into consideration when you're considering investing in any real estate opportunity. So as part of defining our investment goals, we also want to look at what we would consider a successful investment. So as I mentioned a couple slides ago, the cash and income building can come from different sources, even in the same real estate deal. So what would you consider a successful real estate deal? A cash on cash return, which is kind of your regular quarterly or annual dividend, is a total IRR. And you'll see that term, internal rate of return, which is basically the overall return of investment when you factor in the timing of money coming into the deal and money going out of the deal. And then the final question: do you plan on rolling this capital into other deals in the future? One of the great benefits of real estate investment is the ability to take advantage of what's called a 1031 exchange. And I would certainly encourage you to talk to your accountant, CPA, any of your financial advisors on how this may benefit you. But basically, it's the ability to take investment earnings from real estate investment earnings and roll that into future real estate investments without any. You're basically deferring tax consequences to some point in the future. So that's a benefit that you should look into. All right, so we've covered the why. The next question we ask is the where. And these are specific cities or regions or towns or whatever that you may want to invest. These may be areas that you've got experience in, that you've got conviction, that you believe that there's a growth story, that you believe that there is a story of growth that would support investment in some form of real estate. So things to consider when you're looking at your where, defining what your where is. What are the population growth trends? Are these markets that people are moving to, or people moving away from? As we saw during the pandemic, the Sun Belt was a huge beneficiary of people moving out of the West Coast and the Northeast. Partly for weather reasons. A lot milder weather in the Southeast than a lot of areas of the country. Some for better taxing structure in the states and towns. A lot of other reasons. So next, is it a business-friendly environment? Are there specific industries that seem to be growing in state or area or region? Because that's anytime an industry is growing in an area, and they need to bring employees in, there's going to be a need for housing. And at that point, there's also ancillary businesses that will build up around them to support either other suppliers or service-based businesses that come in to support those folks. And the next thing we would look at is, what's the existing housing stock? Is there housing already there? What's the condition? Is it single family? Is it multifamily? What condition is it in? Is it older, newer? What kind of rents are they getting? Is there any new development happening? So those are some of the questions that we ask when we look at the where question. So the next one we look at is who, and this is who do we want to invest with? This is identifying and vetting specific sponsors you want to invest with. Deal sponsors are also known as the general partner or GP. Whereas you investing in a property would be known as an LP or a limited partner. So in our opinion, this is the most important. After your why, this is the most important element of any investment decision, regardless of asset class, particularly given the uncertainty of the market that we're in now. And we'll get into that. As I mentioned a few minutes ago, we've been in roughly 11 to 12 year real estate bull market, and where quite frankly it wasn't that difficult to be successful. The market momentum frankly carried a lot of deals to profitability despite execution issues of the sponsor. Warren Buffett has a famous quote that says, when the tide goes out, you get to see who all has been swimming naked. And when we go into a recessionary environment or a market slowdown, you get to see whose investment theses are going to be tested based on how their properties are performing. I think one thing that's important to note is given where we are in the real estate cycle, there are very few market participants that are under the age of 40 who have been active in the real estate industry through a downturn. So we've been expanding dramatically since, let's call it 2012. If you started your career really much after 2010, you've never really lived in a down cycle before. And they certainly have their level of challenges. And down cycles will teach you probably more than up cycles do. So I think that's an important question to ask. Ask your deal sponsor that you're interested in talking to. how they managed or mitigated challenging markets in the past, and has that impacted any of their deals. So getting deeper into the who question, and we touched upon this at the beginning of our presentation. There's so many different skill sets that are required to successfully acquire or develop and run a multifamily investment. And again, this goes on to any type of real estate investment you consider. And frankly, skills aren't learned overnight. So this is definitely an experienced business that having a lot of reps, swings at the plate count, and those are accumulative over the years. So here are just a few of the things that I identified that sponsors or GPs are responsible for. So this is just a condensed list, but first of all, you have to identify the property that the sponsor is interested in purchasing and investing in, and then completing the full due diligence report. And that's everything from the market studies, the condition of the property itself, where that property stacks up among its competitive set, what's the upside, going through the whole due diligence process, both physically and market-wise. Secondly, you have to create the business plan, which is basically the sponsor's plan for making money out of the property. So what are they going to do? Are they going to renovate units? They're going to raise rents? Are they going to add some amenities that weren't there before? They're going to rebrand and reposition the property versus where it was before, because maybe it didn't have the greatest reputation. So the sponsor is responsible for creating the business plan on how they're going to make money. Number three, securing a loan and securing insurance. And frankly, that's not as easy as just calling up your local bank and calling up your local insurance company, saying, "Hey, I need a loan," and "Hey, I need an insurance policy." Those are complex financial instruments that require a pretty specialized knowledge and good relationships. Frankly, this is a relationship business, and you don't develop a reputation with lenders or vendors overnight. It does take time. Number four, raising capital from investors. Obviously that's a very time-intensive effort. Takes a lot of experience, both deal experience, so you can show a track record and how you've done in the past, but also you have to sell your potential investors on your vision for a specific deal, and also for your company moving forward. Number five, once you raise the money, secure the loan, and close on the property, you actually have to implement the business plan. So that could be hiring and managing general contractors. That could be, bringing in a new management group, which covers number six also, because you have to realize that when you're purchasing multifamily specifically, you're really purchasing an operating business. You've got any number of tenants who already live there that are paying money that on a monthly basis, and they just want to be they just want to know that their trash is going to get picked up and their place is going to look nice, the grass is going to get cut. They don't want to be they don't want to be disrupted from their day-to-day living just because there's been a change in ownership. So you got to be sensitive to them as well. Number seven, managing the finances of the property, making sure that you're collecting the money that's due to you, making sure that your bills are paid, and then also reporting back to investors on a quarterly basis and keeping regular contact with your investors. Number eight, tax reporting. That's a pretty complicated area as well, specifically when you get into cost segregation studies, which is something we should probably speak on another call, but that is a way that helps mitigate a tax burden for real estate investors. And finally, number nine, monitoring when the optimal time to refinance a property or possibly sell it. Given that we're going into we're in a higher interest rate environment, it's a tough time to buy, but also a tough time to sell, depending on when you acquire a property. So, on the portfolio that we own and manage right now, we're being very judicious about how we're game planning our exits from some of these. Fortunately, we're going to do pretty well, but depending on the time that we sell, you have to be cognizant of where the debt markets are and where the acquisition market is before you make a decision to sell or refinance a property. So those are just a few of the things that a general partner is responsible for. And as I mentioned a few minutes ago, you don't learn this overnight. So if you look at some of the relationships a sponsor should have, first of all, you've got to have good relationships with commercial real estate brokers. Human nature is you're going to do business with people you like, but also do business with people that you know perform. And you have to develop relationships with brokers, and they will send you deals once they are confident that you can actually close on. The same as with lenders for debt, particularly agency debt. And when I say agency debt, that's referring to government-sponsored entities like Fannie Mae, Freddie Mac, and HUD. You do need a track record to borrow money through the GSEs. We mentioned insurance carriers a few minutes ago. Property managers, there's no one size fits all on property managers. The property managers are a lot like tools in your toolbox. You pick the right one for the right job. There are some property managers that specialize in, under 50 unit deals that are more urban in nature. There are some that that specialize in large brand new properties that need to be leased up from zero, that are where construction is just finished up. Some are better with kind of Class B suburban suburban deals. So you have to choose the right property manager for the right job, and that gets into building contractors on value add deals. You have to have good relationships with a number of building contractors, and you always have to have several of them working for you, so you can be able to switch back and forth to have optimal time and pricing. Attorneys and CPAs, tax consultant, cost segregation consultant, we discussed that before, data services provider, title company, and engineer. So anyway, there's a lot of relationships that a good sponsor will have that, again, it takes time and experience to develop those. And then reputation and specialization matter. So Mohi and I are big believers in specialization. We really believe in developing expertise in a single asset class, and not just that, but a single asset class in a specific region. What that allows us to do is to understand the nuances of our specific product type. It allows us to understand the intricacies of every market we participate in. We want to develop strong relationships with every service provider that services those markets as well. It could be as simple as there's a right side of the street to own a property on, there's a wrong side of the street to own a property on. And unless you develop that sort of local knowledge and have a team around you that understands that as well, it's easy to make very expensive mistakes. So, we understand that there are other sponsors that play in multiple asset classes. Once, there are private equity groups and other investors that can do that effectively. We believe, though, that specialization, that there's a certain value that comes from specialization in a product type and a region. So finally, when you're vetting the who is, you want to understand how the sponsor evaluates the opportunities that they're considering. So what criteria does your sponsor at GP use to determine what they want to invest in? This goes into product type. Is there a size property? Is there a vintage property? Is there a type of business plan? Are they good at renovating? Are they good at buying new deals and managing those to stabilization? Does your sponsor have sort of a typical return and timing thresholds? What is the typical business plan? What are the market dynamics that your sponsor looks for? This would be, growing or stable or growing populations, an expanding economic base with, a variety of industries. What's the existing competition look like? Are there a lot of other multifamily properties in the area, and what's the vintage on those? What are you competing against when you look at purchasing your property? So all those are important to know when you're vetting your sponsor. So finally, we get to the what. So we've covered, what have we covered so far? We've covered the why, we've covered the where, we've covered the who. Actually, this is the fourth one. So this is the what. This is the specific deal you're investing in. This is, you've determined what your why is, why you're investing in multifamily. You've determined that you want to do business with specific sponsors, and you get a deal from one of your sponsors. So how do you evaluate the specific deal that your sponsor is showing you? So your sponsor will typically share a written presentation when they're ready to raise capital for a deal. And this written presentation, we call ours a deal package. This will detail, the opportunity, what you're buying, the market it's in, and all the nuances of the market, the business plan for creating profit, what the upside is, and how that's going to be achieved, the competition, and so on and so forth. So typically, once this presentation is shared, within a short period of time, typically a few days after that, many sponsors will follow up with a webinar, which will go into further detail on that presentation, and also give you an opportunity to ask questions. So anytime you receive one of those packages, my advice is to make sure that you thoroughly review that information. Make sure that you understand the investment thesis, make sure you understand some of the assumptions your sponsor's making. We'll get into a couple of those questions in a minute to help you with that. And this will help you generate a list of questions to ask when you have the opportunity to do so. So as you see on the screen, I make the point that a lot of real estate's intuitive also. So trust your gut. So I have seldom found that my gut is wrong. There's sometimes I've talked myself into ignoring it, and it typically costs me time and money. So firstly, does the deal make sense to you? When you read the sponsor's presentation, simply does it make sense? Does buying this property in this area with this business plan, with this potential return, does it make sense? And do you trust the story? So again, trust your instincts, ask a lot of questions. So, I've thrown a lot at you so far, but there's also a fine line between understanding and researching all these issues yourself, but also developing a level of trust and rapport with the deal sponsor or GP that you want to work with, whereby you ensure that they're aware of all these issues and have covered them one way or another. So listen, I think it's important for any investor to understand what they're getting into. But there's also a point in time where you have to, you're investing with an intermediary that is a sponsor. At some point, you trust their experience and you trust their business plan, because this is what they're going to be doing every day. So finally, when we get into the market, we talked about the who, what, why, where, and how earlier. There's also the 5 Ps, which is kind of you probably have heard this before. This is a marketing meme that's been around forever. So these are 5 elements that it's important to sort of understand the rationale behind each of these when you're evaluating a deal. So it's not just location, 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 which is the old real estate saying, but it's the 5 Ps. So product, place, price, people, and promotion. So the product is specifically the property that you're buying. Is it 2 bedrooms and 3 bedrooms or 4 bedrooms? What's popular in the market? Is it a 2-bedroom market or a 3-bedroom market? Well, if you got too many 1 bedrooms, but it's a family area, you're probably not going to perform as well as you should. So what is the product? The place, again, we've talked a little bit about that already. Is it an area that is growing? Is it near jobs? Is it near shopping? Is it a convenient area that people want to live in? Or conversely, is it away from things and offers a level of quiet and privacy that folks might want? So there's no one right answer to that. Price, not only the price you're purchasing it for, but the price you're charging it for. Do the rents that you're currently charging for your property and the pro forma rents that you're targeting once you finish your value add plan, Do those rents make sense? Are you going to be the most expensive? You're going to be in the middle of the market. You're going to be at the low end of the market. Frankly, we always try to target being right in the middle of our competitors in terms of pricing. We never want to be the most expensive, and really don't want to be the cheapest either. So people gets into who's executing your business plan. This is what contractors are working for you to get your job done. What management company are you using to execute your business plan? I think it's important to realize that just hiring a third-party manager to manage the day-to-day of your property does not mean they're executing your business plan. So as sponsors, it's incumbent on the deal sponsor to stay in the weeds and be involved with your property manager and everybody who's executing the plan. And then finally, promotion, and that's how are you promoting this deal? Are you listing it on Facebook Marketplace and Craigslist and Apartments.com and all of the other? Are you doing direct mail marketing? Are you doing TikTok and Twitter and Facebook and things like that? So anyway, those are some of the deal issues. So finally, we're wrapping up the what property specific issues. This is important for you as an investor to understand, but again, it's incumbent on you to make sure your sponsor can address these questions as well. So first of all, the condition of the property. Is it new? Is it old? Is it an A, B, or C? Where's it stack up in its competition? What's its occupancy level? And what's its occupancy level relative to its competition? And if it's, there's actually two types of occupancy. There's physical occupancy. That's how many people actually how many live bodies reside in units. And then there's something called economic occupancy, which is actually how many of those live people in units are paying rent on a timely basis. You would hope those are the same number, but it very seldom is in multifamily properties. So for instance, you may have 90% occupied units, but only 80% of your tenants are paying. So you've got a 10% collection issue. So your functional vacancy is 20%, not 10%. So that gets to the next point, which is cash flow and collections. How's the cash flow look from the property? Is it enough to cover its expenses? Is it enough to frankly comply with your loan covenants that most loans have a certain minimum cash flow requirement? And how's your property manager doing? Are they equipped? Are they the right tool out of the toolbox to handle this specific property? Is it kind of within their wheelhouse of expertise? And then finally, a question that I like to ask is there at the bottom of the page. At the end of the business plan, if your sponsor executes 100%, does exactly what they say they're going to do, who's going to buy it at the end of the business plan, and why are they going to buy it? So I think it's an important question. You may not know 100%, but you should have a good sense of how you're going to get into a property. You have to have a thesis on how you're going to get out of a property. So, all right, so that's 4 of the 5, and then we're finally to the last one, which is the how, and that's how is the sponsor going to execute their business plan, and are there any time bombs that I call them in the business plan that could impair the deal, slow the business plan, or result in a capital call? Now, a capital call, it's one of those things that's addressed in the fine print of an offering when you sign up to be an investor. So a capital call is basically a very unfortunate event where there's a cash shortage to do whatever, to either finish executing a business plan, to pay taxes, to pay insurance, whatever it is, and the sponsor has to go back to the investors and ask the investors to contribute more money to the property. So I think it's important upfront for you to look at the business plan, make sure that any potential time bombs, or what I'm calling time bombs, are addressed, and there are mitigants to prevent any future capital calls. So one would be a loan maturity. So if you've got a sponsor that has a lot of bridge loans, originally in the last few years have been 3 years in duration, with a couple of extensions. Well, what if you hit a loan maturity and you can't refinance into a less expensive agency loan? What then? Well, that's a big problem to have, and we're hearing of a lot of deals that are running into that exact problem. Are your expenses fully capitalized or accounted for? Fully capitalized meaning have you raised the money for it, or are the funds in the loan to be able to draw on? That's if your sponsor is going to spend $1 million to renovate 100 units. Well, where's that $1 million? Is it already in an escrow account, CapEx account somewhere, or does the loan have enough money for them to be able to draw that down? And if not, what's the plan to pay for those expenses? Tax and insurance assumptions. You need to look at the business plan to make sure, anytime a property trades hands, there's a tax reassessment. So the local municipality is going to take the opportunity to reassess the taxes, and typically, like anything with government, it's going to be more expensive. So has your sponsor assumed that taxes are going to go up when they purchase the property? And almost more important than that now, what are the insurance assumptions? These days, I'm not sure if any of you are keeping tabs on the insurance market, but the property insurance and liability insurance market has gotten pretty crazy the last year or so. It's not uncommon to find insurance premiums doubling and tripling for deals that really have had little, if any, insurance claims over the past couple of years. There are coastal markets where sponsors don't have any options, where insurance companies are pulling out of those markets entirely. So it's important that you make sure that your sponsor has realistic insurance premium assumptions in their financial models. So let's move on to the next one. So here we are at the summary. So what I would suggest doing, again, there's no such thing as passive investment, and I know that's a term that gets used a lot. But frankly, anything you're going to commit money or effort to, there's no level of passive to it. I mean, you need to educate yourself. You need to become familiar with the terminology and how things work. So you're going to need to commit some time to understanding that. There are a lot of nuances to any type of investing, real estate investing specifically. And I encourage you to spend some time learning, determining your why, and figuring out the where and the who early in your real estate investing career. That will be time well spent. And then finally, just a couple rules of thumb that we like to live by. If the deal seems too good to be true, it probably is. That's applied to almost everything in life, isn't it? And then find sponsors you can trust. I think it makes a lot more sense, and you'll sleep better at night to do good, solid deals with groups that you trust and feel comfortable with, than try to do great home run deals that time with, or you're not entirely sure they're capable of pulling that off. So, we're going to open it up to Q&A in just a second. One thing I did want to mention before we get into the Q&A session is that given the point in the market that we're in, we are still evaluating deals. We're still looking at a number of what we're considering fairly compelling opportunities. The market has changed somewhat in the last few months. Seller expectations and buyer expectations are starting to meet in the middle. We're starting to see a number of newer vintage properties trading at or below replacement cost, which we're excited about. We're also seeing kind of Class B, B plus properties in well-located, economically diversified areas come down into ranges that make a lot of sense. So we're working on a handful of really compelling deals right now that we hope to share with you in the very near future. So, I think we've got your contact information. We'd like to share those with you when the time is appropriate. So at this point, if you have any questions, please add those into the chat, and we'll spend a few minutes on that. And if you need to drop, I appreciate your time, and look forward to getting together with you on the next one. And if there are specific topics that you'd like to hear us speak about, or certain questions that you have, we would we'd like to hear about those. We'd like to give you information that is valuable to you. So please let us know about that. And then finally, if you joined late, and didn't catch the beginning, we are going to have a replay of this webinar available. So we will send out the link to that once it's available, and hopefully you'll get a chance to look at that. And again, you know, our contact information is available, and we would like to talk to you whenever you can. So we'll wait a minute or two to see if any questions, and if not, we will look forward to the next one. All right. Don't see any. We hope to have the recording available by the end of the week. Somebody just asked that. Thank you, Hassan. Yeah, we hope to have the recording by the end of the week, but we will send out a link to everyone who registered. Okay. Thanks, everybody. We'll look for you next time. Have a great day.